Hello, welcome everyone to another financial analysis video with myself, Moed, and my colleague, Ted Wayman. Today, we're going to be looking at Gfinity, right? So they are a games, an esports, esports company, esports experience company. So think of virtual or live programs, competitions, etc., that they would do for games publishers, brands, media companies. So people will rock up to an event, Call of Duty event, for example, and they'll have competition, and the winner of that competition will win £30,000, for example. So that's a big part of what they do. They also have something called Gfinity digital media arm of the business. So that's basically media publishing. So essentially they do kind of gaming entertainment on their websites, talking about the gaming world, the hardware world when it comes to gaming, etc. So they have a bit of an arm in relation to that. Now, we're going to be looking at their financial statements today. Now, one thing to note is that this particular video is a request from a couple of our viewers, right? So, we take a lot of these requests. And so, in fact, about 98% of our videos come from requests from you, the viewer. So why do I mention this? Because you shape what we put out there. So if you're interested in a company, whether you're thinking about investing in them, selling to them, or working for them, do leave a note in the comment section and make your request and give us some context, because if it's a great context and great reason, we might prioritize you or bump you up that priority ladder. So one thing to note is before we go on to the financial statement, a couple of things to note. Number one, the share price. So they floated in 2015, and based upon the share price, they haven't been doing very well. And we're going to go on to that, so stick around. But since they floated, their share price has been down 95%. In the last 5 years, it's been down 91%. And in the last year, it's been down 68%. So it hasn't been doing very well. And we're going to go into maybe what the fundamental financial statements is going to show about that. But as always, you have to look to the future. We're going to be looking at the past. And on that note, our job and the purpose of this show is not to help you with investment advice or to analyze a business in terms of whether you should be investing in them or not. We're not here to do that. And we're not here to give you that kind of advice. There are plenty of other people out there that do that very well. Our job and our purpose is to raise the financial fluency or literacy of everyone who's watching this. That means helping you be able to analyze financial statements in order for you to then make decisions based upon what you want to do with this business. And we're going to be looking at the audited annual report. But from our video and from the way that we help you think about that and analyze certain things, that's going to help you analyze their quarterly reports, half-year reports, etc. So for Sean that made the request, and he says that there's going to be a half-year report in March, based upon last year, that's probably going to come out around 29th of March. But this video is going to help you better analyze that half-year statement. So Ted, we can take it away and share with our viewers what we've uncovered about this company and the underlying financials here.
Absolutely. So good to see you, Moed. Thank you very much. And yes, absolutely right. So our viewer asked us to look at the half year report, but unfortunately at the time of recording that is not available. But it's relatively straightforward to be able to look at the sort of, we can look at the full year and give you a kind of an idea of what to look at if you are looking at the full year. Here are their annual report and account. I'm pretty sure that's Michaela Strachan on the front cover, looking very young. I may be wrong there, but if I am wrong, then do let me know who it is. So here's their financial statements 2021. Lots of lovely, pretty pictures and logos and all the rest of it, telling you about who they are and what they do. I have to admit, a bit like you, Moed, I kind of struggle to get my head around exactly their business model. But as I said, we're looking at the numbers, and we're going to look at what the numbers are telling us about this business. And the numbers start here. So here we have the auditor's report. We'll whiz through the auditor's report into the actual financial statement. So this is the income statement. So the income statement, we are dealing in pounds. So the revenue of this company is just shy of £6 million pounds. Okay, it's not big, it's not massive. This is a pretty small company with a sort of 5.7 million pound turnover, and that's up. So it's up 27% on the previous year, so that's good. So 27% increase. And then we've got the cost of sales. Honestly, I have no idea what. I guess that's kind of the cost of putting on the events. If they're getting lots of people in a room to play Call of Duty, they've got to hire the room and hire the game bits and pieces and all that kind of stuff. So that's a 3 million, leaving them with a gross profit of 2.6 million. And if I'm wrong, by the way, if that's not what they do and somebody knows that, just put it in the comments and teach me a thing or two. But do it politely. Obviously, we're all being polite to each other on this channel. So 2.6 million leaves them with a 46% gross margin, down from 62% last year. Is it good? Is it bad? Honestly, I don't know. I don't know this kind of industry at all, but they are making a profit, and that's all looking pretty nice. The problem comes at this level here. Admin expenses, they were 11 million or 10.7 million. They've got them down to 7 million. They're still too high. They're making an operating loss. So they were making an operating loss of 7.8 million. Their operating loss has fallen to 4.5 million, but an operating loss is an operating loss. There's a little bit of finance costs, suggesting that maybe they've got a little bit of debt, or maybe they're going to they've got some hire purchase contracts on some of their assets. And then the tax, well, the tax is positive because they're getting rebates because they're making losses, so you can actually claim tax back. The bottom line is that they are making a loss. They were making a 7.7 million loss, and now they're making a 3.8 million loss. So they managed to get it, reduce the loss from a negative 172% bottom line margin down to negative 68%, but it's still a loss, and that does not look too good to me. So profit and loss account not looking very healthy, especially as it's meant to be around for a while. I mean, I kind of get a startup company trying to find its feet and so on and so forth, but these guys have been around for a while, and they haven't managed to generate the revenue that they think is the potential. So just having a look at the income statement, Moed, if you just look at these numbers here, if you actually start with negative 4516977, you add 706, you add 4, and then you deduct 10236, you actually don't get down to 524 negative. Okay, it's only a one difference. It's a £1 difference, and it's very small, and it's a rounding error. It's obviously in a rounding error, but I just kind of whenever I get a set of accounts and they don't add up, it just loses a little bit of confidence. It's kind of like, guys, it's not that difficult. Get the numbers to add up. Maybe that's the accountant in me. It is only £1. It's not going to distort my view of the accounts, but it wouldn't have been rocket science just to put the right numbers in and get it to add up. Anyway, let's go on to the balance sheet. Here is the balance sheet. So we are looking at the assets. They have got total assets. These are the current assets down here. So they've got about 1.4 million in cash and about another 1.6 million in trade receivables. Very similar to the previous year, 1.6 million in cash, 1.4 million in trade receivables. That's looking fine. And then up at the top, we've got the non-current assets, the thing they need to run the business. You'll notice the property, plant and equipment is very, very small. It's really all goodwill. Okay, and this goodwill, quite interesting, the goodwill has fallen. So either they've been writing it off or they've been getting rid of some of their companies. The right of use assets, these are the assets they've got on hire purchase kind of thing, that's gone to 0. And the property, plant and equipment has shrunk a little bit, suggesting that they've depreciated it and they haven't been replacing it. So the non-current assets has shrunk significantly, which is not really what you want to see if you're investing in a company that is meant to be growing. Bottom half of the balance sheet, here are the current liabilities. So the current liabilities, this number here, which is 1.8 million. And again, we would typically just compare that to the current assets of about 3 million. And so the liquidity ratio is looking fine. Their non-current liabilities are these two numbers here, which is a little bit of kind of other payables and deferred tax liabilities. So the interest they're paying looks like they're paying interest on the kind of the assets which are under hire purchase. And again, I just, it's kind of, it's not a big deal, but it's like, what is this number here in the previous year? It's just kind of like, it's just a question mark. It shouldn't be there. Okay, they're trading other payables. That's fine. I get that. They've got some deferred tax. And if you add these two numbers together, then you get the total liabilities. That's fine. And they suddenly just stuck this random number in. It's absolutely meaningless. And it's kind of like, you just lose your confidence in a company that A, can't make the numbers add up, and B, just maybe I'm missing something. And if I am missing something, then please somebody mention it to me in the comments as to what that number is. But it certainly isn't the total current liabilities. At least it shouldn't be, because then the balance sheet doesn't add up. So you've just got these kind of this random numbers not adding up, random numbers being stuck in, and I'm losing confidence in the kind of, if you can't produce a decent set of accounts, then you probably shouldn't be running a business, certainly a listed business. Anyway, that's just my opinion. Looking at the equity, more importantly though, so looking at the equity up here. So here's the equity funding the business. And what do we see? Well, this company is, this is what the investors have invested in the company, which is about 47.5 million pounds. And the company is sitting on substantial losses. So 47 million pounds invested in the company, 47 million pounds has been lost. How long is that going to go on for? How long are the investors going to carry on just investing in this company? And they are still investing. Look, you can see that these numbers have increased, and we will also be able to see that in the cash flow statement. We'll see this company is raising more money. It's losing money. The cash is the same. The only way it can maintain that cash is by issuing more shares. Going back to the shareholders and saying, no, stick with us. We are a good bet. We're a good story. We're going to turn the corner. We're going to come to profitability. We're going to make your fortunes. Okay, it's looking pretty high risk here. Let's go and look at so here's the changes in equity. There's nothing really to write home about here. They're making a loss. They're not paying out dividends, of course. And the losses are just piling up. So as we said, they're making a loss of, they're sitting on a loss of 47 million. Here's the cash flow. First line, negative cash flow. Now there's a reconciliation. If you want to see how the kind of operating loss reconciles to the negative cash flow, you've got to go and look at note 23. We see that often that companies, IFRS and US GAAP will put it actually in the face of the cash flow statement. These guys, I think, are under UK GAAP and can put it into a note, and that's absolutely fine. And the cash burn isn't as bad as it was last year. So 5.3 million is a big cash burn. 2 million, relatively speaking, is less of a cash burn, but a cash burn is a cash burn is a cash burn. The investing activities, quite interesting what's going on in the investing activities. So there's a little bit of kind of additions to their property, plant and equipment, but I think the most interesting one, I'll put it in a different color so that we can kind of see it, obviously, is that last year they made an investment in an associate, and then it looks like they've sold that investment, and they've made a gain on disposal. So they have made a small gain on a disposal of something they bought last year. That's my guess. I haven't looked at the kind of the exact commentary. And that's going to be why the goodwill has fallen, because, as I said, if you sell a company, you need to remove the goodwill associated with that company from when you bought it in the first place. So they are, they've got a positive cash flow from this investing activity, but again, once you've sold your associate, you can't sell it again. So it's a bit like what we call selling the family silver. You can only sell it once, so make sure it's the right thing to do. You're not going to live off it. And then we can see here issue of share capital. So they've raised 2 million by issuing shares. Last year they raised 7 million by issuing shares. They've used it to repay some leases. They're paying some bank interest, and so that gives them the cash you know, they are basically raising cash from financing activities. So this number here, this is why they've got a pretty positive cash flow. So the cash is going up, and again, they still got, you know, quite a lot of cash in there. So 1.4 million of cash. You know, if you've got 1.4 million in cash, and you're burning, you know, you're 2 million a year, then you're not going to survive the year. So obviously they have survived the year. We expect them to survive the year. So it'd be quite interesting to see that kind of, you know, that quarter or that half year update. But you know what I mean? So Moed, you know, my reading of this, these guys are losing money. They've been losing money for a very long time. I can't see them, you know, not losing money. You know, they go back to the shareholders. They say to the shareholders, oh, you know, can we raise some more money by issuing shares? There's no debt. The banks are not going to touch these guys with a barge pole for obvious reasons. And therefore, I would kind of, you know, put this as very much a kind of caveat emptor. In terms of, you know, the business. Now I'm just having a quick look at the independent auditors report, and you might just sort of find there's a little bit in here about the going concern. And so here we go. Here is that that key audit matter, going concern. And this is basically saying exactly what I've been saying. They're losing money. They're making a loss. If they go back to the market, they issue more shares and they try to raise more capital. If the shareholders go no, then that's it. It's game over. They're going to go bust. So I just, you know what, I'm not convinced. You know, certainly I'm not an investor in this company. You know, I can't see, you know, maybe, and don't forget, you know, there'll be some investors who kind of go, well, I've put all this money in, I have to, you know, I've got to see it, you know, it's got to come good at some point. And that can be a little bit of a fool's game. You know, usually first loss is best loss, as they say. And you know, you mentioned the share price. Here is the share price, and I think the share price just reflects exactly what I've been saying. So, you know, when I see the share price after seeing those accounts, you know, it's gone down. It's right down the very bottom. That's not to say it can't keep going down. So, you know, you can still buy at 148 and lose all your money as it goes bust. There's no price to earnings ratio because there's no earnings. There's no dividend yield because there's no dividend. It's a loss-making business. 17 million. You know, interesting enough, there's still goodwill sitting in there. So the balance sheet, just remind myself, so the balance sheet, 3.5 million of net assets, mainly cattle, you know, predominantly cash. You know, that 3.5 million is cash and trade receivables, but they're burning cash. You know, the expenses that they're going to pile through it. So it's 14.3 million of goodwill, and I'm not convinced by that at all. So there you go, Moed. There's my take on it. You know, thank you very much, but as the dragon said, I'm not investing.
Sounds fair. So that was interesting to see, particularly around the burn of cash and therefore the going concern. So Sean, who made the request, you know, hopefully this was of value for you. Really look at your investments and, you know, make your own conclusions. We're not here to give you advice. We're just here to tell you what we see on the financials. So do like, share, subscribe this video. If you have any comments, as Ted mentioned, if you know about this company or know about the industry, do share your expertise and knowledge here. Be polite, of course. This is a polite community. And of course, if you have, just like Sean did, if you have a company that you're interested in, whether you want to invest in the company, sell to the company, or work for the company, do leave a note in the comment section with some context so that we can understand you know, why you're interested in this business, and we can adapt our analysis to suit your circumstance. So until the next video, thank you, Ted. Thank you, everyone else, and we will see you on the next analysis.
Good to see you, Moed. Catch you later.